Now, when you retire, and this is no surprise, but the paycheck stops. When you're working a job every couple of weeks, there's an amount of money that shows up in your bank account, and that allows you to pay all of your bills. But one of the biggest challenges after you retire is, where is the money going to come from to pay your bills? Now, part of the money hopefully will come from a pension or Social Security, but normally there is a gap, and the question then becomes, where should you pull money from to fill that gap? Should you pull it from your taxable account? Should you pull it from your Roth IRA? Or should you pull it from your 401k? And choosing the wrong account can have a surprisingly large impact on the long-term success of your retirement plan, especially because there are some significant tax implications if you pull from the wrong account first. Let me just show you a quick example. So here we have two different strategies. We have the pro rata strategy, which is just pulling a little bit from each account that you have. And then we have a more nuanced strategy for this particular person, where we're going to pull from their taxable account first, then their tax-free account, or their tax-deferred account, then their tax-free account. In this account, and this is just a fairly typical family, I think they have about $1.4 million, and we're going to walk through this in detail in just a minute, but it can mean the difference in almost $500,000 in their portfolio throughout the life of their retirement. So in this video, I'm going to talk you through the optimal order to withdraw retirement funds to minimize taxes. We're going to cover understanding your fixed income sources, knowing the tax implications of the various account types, filling tax brackets strategically, and finally preparing for one of the biggest tax issues that most retirees face. This video is going to be incredibly practical and hands-on, and at the end, I'm going to give you free access to the same software that I'm using in this example so you can play with it yourself. But first, my name is Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping 1 million people retire without worry. Now, as we just said, when you retire, you go from receiving a paycheck each week or every other week to generating your own paycheck from various income sources. And the order that you tap these sources has huge tax implications. So let's walk through how to withdraw retirement funds in the most tax-efficient order possible. So step one, and this is not too dissimilar from just preparing for retirement in general, but you need to know your fixed income sources. What is your guaranteed income? So for example, do you have Social Security? Do you have a pension? Maybe you have an annuity, rental income, business income. What are your guaranteed income sources? These provide a baseline of secure income before you need to tap your retirement account. In fact, when we're building out a retirement plan, one of the first things we want to do is find out what percentage of your income or of your expenses will be covered using a fixed income source. So for many people, they might find, if they need $10,000 a month, I'm just making these numbers up, but if they need $10,000 a month, maybe $4,000 will come from Social Security. So 40% of their fixed income costs are covered by Social Security. And so then they need to figure out how to make up an additional 60%. So you need to know what these income sources are, and you need to know when these income sources kick in. This is especially relevant when it comes to Social Security, because for some people, if you're going to retire early, maybe at age 60, and you want to delay taking Social Security maybe to your full retirement age, that means you could have 6 to 7 years where you have to make up your income entirely from other sources. And so you want to know what those numbers are as well. So the second thing you want to do is you want to calculate the gap. So going back to our example, your expenses are $10,000 a month. You have $4,000 a month coming in Social Security, so 40% of your expenses are covered by Social Security. That leaves 60% of your expenses, or $6,000 a month, that needs to be covered by other income sources. That's the gap. And you need to know what the gap is between your fixed income sources and your target spending goal. So in this example, your expenses are $120,000 a year or $10,000 a month. You have $4,000 a month or $48,000 a year that is coming in from Social Security. And so that additional amount of money, the difference between $120,000 and $48,000, that's the gap. In this case, that gap is $72,000. So you're going to need to pull $72,000 a year from your portfolio or from some other income source. If you plan on retiring early and delaying Social Security, you may end up having a $120,000 gap at the beginning of your retirement. Now, that's not necessarily a bad thing. In fact, often I encourage people to retire earlier before Social Security kicks in, to give them some space without income coming in to begin allowing them to do Roth conversions and also allowing them to begin pulling some money from their taxable account, potentially tax-free. So the second thing you want to do is just know what that gap is. What's the difference between your fixed income sources and your expenses, and how much are you going to need to pull on an annual basis from your various portfolios? Now, the third step is you need to know what type of retirement or investment accounts that you have. Most clients that come to me have their money spread across a mixture of accounts, and you need to know the account types and the tax rules surrounding those account types. So you'll likely have a taxable account. So this is a brokerage account or a trust. And the way it works is you buy stock. Let's say you buy Apple at $100 a share, and now Apple is $200 a share. If you sell that stock, you're going to have to pay long-term capital gains on the difference between the purchase price and the sale price. So in this example, there's $100 of profit. If you sell it, you're going to pay long-term capital gains on $100, assuming that you've held it for at least a year. Now, the taxable account is interesting because the money inside this account that passes on to your heirs gets a stepped-up basis. So often, if you're under a certain threshold, all the money inside a taxable account or a trust account can go to your heirs completely tax-free, which is a benefit over the tax-deferred account. So most clients that come to me have the majority of their wealth in a tax-deferred account, either a traditional IRA or a 401k. With these accounts, you get a tax deduction when the money goes in. So with the taxable account, there was no tax deduction. You just put money in the account, you bought stock or you bought an ETF, and then you sold at some point. With the tax-deferred account, you often, and there are various rules around this, but most people, when they put money into a tax-deferred account, they get a tax deduction up front. So if you put $20,000 into your 401k this year, you'll be able to take $20,000 off of your taxes. But here's the downside. That 401k or that traditional IRA where most of your wealth is, gave you a tax deduction when the money went in. It's grown tax-free for the past 30 years. But now that you're in retirement and you go to take money out of that account, now the IRS is going to tax that money as ordinary income. So if you pull out $100,000 out of your 401k or your traditional IRA, you're going to pay tax just like you would on a paycheck on $100,000. It's not treated as long-term capital gains. The other important thing to know is that if this money passes on to your heirs, they're going to pay tax on as well. It's not tax-free for them. So it's really important to be strategic around these tax-deferred accounts. The next type of account is a tax-free account. This is a Roth IRA or Roth 401k. So the money that went into this account, you didn't receive a tax deduction similar to a taxable account, but it's been growing for the past 20 years, completely tax-free, and anything that you take out of this account will come out tax-free. So you put in $10,000 and now you have $100,000 in there. You have $90,000 in profit. You're able to pull out the full $100,000 without any tax implication. So each account has different tax treatments on withdrawals. And so being strategic around which account you pull from first is going to be really important. You want to minimize your taxes. And this is the trickiest part of retirement planning, honestly, because there are so many tax rules that you're playing with, and the order of withdrawals can have a massive implication throughout your life. So what I want to do is I want to walk through a real life example using Phil and Claire Dunphy. Phil and Claire live in the state of California. They plan to retire when Phil is 62 and Claire is 55. We've run the numbers and discovered that Phil should wait till age 70 to claim Social Security, and Claire should wait until age 67. So there's a fairly big gap between when they retire and when they can claim Social Security. So let's switch over to my other screen, and I want to walk through their particular tax situation. So here we have my clients, Phil and Claire Dunphy. They have about $50,000 in the bank. They have investment accounts of $1.4 million. $500,000 of that is in a taxable account. And as you notice here, the cost basis, that's the price they paid for the stock, is $250,000. So they have about $250,000 in long-term capital gains. Phil has a 401k with $400,000. He also has a Roth with $100,000, and then Claire has a 401k with $300,000. Now let's go over and look at their income. Right now they earn $170,000 and $140,000, but Phil's Social Security statement at full retirement age is going to be $3,200, and Claire's at full retirement age is going to be $2,800. So those are the fixed income sources that they'll have coming in once they begin taking Social Security. But as you remember, they're going to delay taking Social Security till age 70 for Phil, till age 67 for Claire. So now let's go over to the tax tab, and this is where we're going to spend most of our time. Let's click on distribution here. And so what we have here is we can look at the different scenarios and how they go about withdrawing the money. So often people will pull it out on a pro rata basis. They'll pull out equal amounts from their taxable account, their tax-free account, and their tax-deferred account. But as we can see, pulling out from the taxable account first, then the tax-deferred, then the tax-free can mean about $500,000 in additional value or tax-adjusted value at the end of the portfolio. And that also includes any tax that the heirs might have to pay on the portfolio if there's money left over. So as you see here, we're able to set a terminal tax rate of 22%. So here we have almost $500,000 more in value on their account if they do a taxable, tax-deferred, and tax-free. But let's check other strategies. What if they did taxable, tax-free, and tax-deferred? So we see here that is actually even worse than taxable and then pro rata. Not quite as bad, but still not great. So let's go back up to the pro rata so we can see 500,000. Now, one thing I'm not going to get into here, but becomes very important, I'm going to do another video on it, is doing Roth conversions, because they have $800,000 in a 401k. So what difference would doing a Roth conversion make for them? So let's just say they fill up the tax bucket to the 12 or 15% tax bracket. Well, it could mean $1.8 million more over the life of their portfolio. So it's really important to understand the impact of these various strategies around taxes. But right now we want to just talk about the withdrawal strategy. So we're going to turn that off. And we're going to go over here to the detail. So as you can see, this is how much they're going to pay in taxes. And you're going to notice, even though they're pulling, let's actually go here first. Let's look at the withdrawals. So they're going to take $100,000 a year over the next 7 or 8 years from their taxable account here. And then they're going to switch and begin pulling from their tax-deferred account. So now we can actually look at the tax details. As you can see, they pay $0 in tax. And the reason they pay $0 in tax, even though they have a $250,000 gain, is because you can pull money from your taxable account as long as you have no other income coming in. You can pull over $100,000 when you're married filing jointly in long-term capital gains from an account completely tax-free. Don't go out and sell everything in your portfolio because some guy on the internet said you could. Talk to your tax professional or to your financial advisor about this strategy. But it's an incredible strategy for pulling money out of your account completely tax-free. So as you see here, they have no tax. And then once they start pulling from their tax-deferred account, they start having tax. And then as you see, as they pull more and more money from that account, and this is why Roth conversions are so important, because as they start pulling more money, they start moving up the tax bracket. And their taxes, the amount of federal income taxes they're paying later in life is significantly higher than earlier in life. This also can impact their Social Security because those increased withdrawals from your tax-deferred accounts, the tax on that can also cause more of your Social Security benefit to be taxed as well, which is another reason that you do a Roth conversion. And then the other thing you always want to pay attention to is Medicare premiums. If you have too high of income, it can cause your Medicare premiums to go up as well. So you can see here that they don't ever cross that threshold, so they're fine. Now, I just realized it doesn't actually change the total amount, but the brackets I was in was the Medicare premium bracket. So you can see, as you cross these different income thresholds, it increases the amount you have to pay in your Medicare premium. But we actually just want to be in the ordinary income bracket. And so you can see as they start crossing above these areas, you can see it impacts the tax rate that they'll pay on each additional dollar. So that gives you a glimpse into one person's situation. Your situation could be very different. But what I will tell you is be very careful what you read online or what you watch on the internet without actually running the numbers for your specific situation. Just a couple of other notes that I want to make as we end. One thing around, you'll notice that in all these strategies, it seems to make most sense to withdraw from the tax-free accounts last. The reason you want to withdraw from tax-free accounts last is you want to give that money as long as possible to grow, because that money is going to come out tax-free. So you want to let that money compound as long as possible. If you start by withdrawing from your tax-free account, it feels great because you're not paying any tax on this income that you have coming in. But the problem is that you are ending the compounding early. And so you want to allow that Roth IRA or that Roth 401k to compound as long as possible. The other thing you want to be mindful of is taxes on your Social Security. The more money that you're paying from your tax-deferred account, the higher the tax on your Social Security. This is why RMDs can be very tricky. And this is also why you want to seriously consider doing a Roth conversion. But I'm going to do another video on that where I'll kind of walk you through some basics of a Roth conversion. The other thing you want to pay attention to is your Medicare premiums. So, if you have too much income coming in, it can cause your Medicare premiums to be taxed. The other thing to be mindful of is how the assets or how these different accounts pass to your heirs. So as we talked about, a taxable account, you'll get a stepped up basis. And then also on a Roth account, as long as you're not subject to any sort of estate tax, money inside of a Roth will all pass to your heirs tax-free as well. Whereas money inside of that tax-deferred account, the 401k, the traditional IRA, your family is going to pay tax on that. So you want to be aware of that as well. And finally, I just keep coming back to this, but you want to be prepared for required minimum distributions. And like I said, I'm going to do another video on this, so I'm not going to get into this. But one of the biggest risks to your retirement plan and to being able to minimize your tax burden is your future RMDs. Because at some point, the government is going to begin forcing you to pull money out of those accounts through RMDs, and it can make it very difficult managing your income. And so not managing those RMDs properly can cause a large tax bill at the point in your life when your income is most vulnerable. So in conclusion, managing the sequence of withdrawals can make a huge difference in your lifetime tax burden. But if you're very strategic in selecting which accounts you draw money from first, it can really help maximize your long-term portfolio value and help make your retirement plan more secure. Now, at the beginning of this video, I promised you I was going to give you access to the software. So in the show notes, you're going to see a link for software called Right Capital. That's what we use to do this analysis. And once you create your account, it's going to send me a notification, and then I can turn on access to this area. It doesn't come automatic, but I'll turn the access on so you can play around with these numbers yourself. And then if you're looking for a financial advisor, you're like, this is just a bit overwhelming. I want somebody else to develop this plan for me and to help me manage it. Feel free to schedule a call. I'd love to chat with you. And finally, if you are, as we were talking about this, you're thinking, wait, how is this impacting how my Social Security gets taxed? I have an entire video where I go into exactly how Social Security is taxed and how you can work around that and help reduce the tax on your Social Security benefit. And you can watch that now.